This one chart explains why the US economy is completely dysfunctional. It shows us that the system has been flipped inside out. And not only has it been that way for over a decade, but it has reached an extreme level that has pushed us past the point of no return. We are often told that the economy is doing great. We see the GDP numbers go up. We see the stock market hitting all-time highs. But if you talk to the average person, if you look at your own bank account, or if you simply go to the grocery store, it doesn't feel great. In fact, for many, it feels like a recession. Why is there such a massive disconnect between the headlines and reality? Why is Wall Street partying while Main Street is struggling to pay the bills? The answer lies in the data I'm about to show you. It proves that the engine of the American economy has fundamentally changed. We are witnessing a massive transfer of wealth, a separation between corporate success and human well-being. My name is Alex, and welcome to Invests with Alex. Today, we are going to dive deep into the numbers to uncover the truth about corporate greed, the broken tax system, and the 50% stock market crash that could happen if this system ever tries to correct itself. Let's dive in. To understand where we are going, we first have to look at where we came from. We need to look at the history of how money flowed in this country. This line shows us how the profits of U.S. corporations have grown since the 1980s. And this line shows us how personal income, the money you and I bring home, has grown. If you look at the 1980s and the 1990s, you see a healthy relationship. In fact, during those decades, personal income was actually growing faster than corporate profits. This was the era of the thriving middle class. The logic was simple. When people made money, they spent money. That spending became corporate profits. It was a cycle that fed itself. The consumer was the engine. But then, something broke. In the last 15 years, specifically starting around 2002, we have seen that relationship completely flip around. And this flip has sown the seeds for the major transfer of wealth we are seeing today. Let's look at the specific growth rates, because the math here is startling. Between 1947 and 2002, the real annual growth rate of corporate profits was 2.7%. That was the historical norm. It was steady, sustainable growth. But in the last 2 decades, that trajectory has been shattered. Since 2002, corporate profits have adopted a new, explosive growth rate of roughly 5.1% per year, adjusted for inflation. Profits are growing almost twice as fast as they used to. Now you might think, well, if companies are making double the money, surely the workers are making more too, right? Wrong. In fact, personal income has done the exact opposite. Prior to 2002, personal income grew at an annual rate of 3.4%. But between 2002 and the present day, that growth rate has collapsed to a measly 2%. So let that sink in for a second. Corporate profit growth doubled. Your income growth got cut in half. This is not a coincidence. This is not just market forces at work. This is a structural change in how the economic pie is divided. And this brings us to the most important concept you need to understand, the economic pie. Most economic data, like GDP, focuses on whether the whole pie is getting bigger. And yes, the US GDP is growing. The pie is getting larger. Politicians love to brag about this. But what they don't talk about is how that pie is being sliced. When we look at personal income as a percentage of GDP versus corporate profits as a percentage of GDP, we see a war for resources. Historically, these two lines move opposite to one another. It is a zero-sum game. When personal income rises as a share of the economy, corporate profit share declines. And when personal income share declines, corporate profits skyrocket. Since the 1980s, the share of the economy going to regular people has been in a freefall. Meanwhile, the share going to corporations has grown substantially. The gap between these two lines right now is about as large as it was in 2009, right after the Great Financial Crisis. This explains the mystery. This explains why real GDP can beat expectations quarter after quarter. It explains why we can have low inflation on paper and a booming stock market, while simultaneously dealing with a cost of living crisis, a housing affordability crisis, record low consumer sentiment, and increasing social unrest. The economy is growing, yes, but you aren't invited to the party. The profits have taken up a larger share of the pie to the direct detriment of your income. Now, this is why we also think this is one of the most critical moments in history to be an active investor. Because while the real economy, the economy of wages and grocery bills, is down the gutter, the financial markets are operating in a different reality. There has rarely been this much opportunity to make money in the markets if you know where to look. We actually just released a quarterly report where we dive into specific sectors and assets that we think can outperform in this exact environment. We break down the opportunities we are taking advantage of, despite this divergence between the real economy and the financial system. I've made that report temporarily free for my viewers, so you can download it using the link in the description below. But let's get back to the core question. Why? Why did this happen? Did corporations suddenly become twice as smart in 2002? Did they invent a magic money machine? No. The answer is not productivity. The answer is taxes. This next chart is the smoking gun. It shows us corporate profits as a percentage of GDP, but it compares pre-tax profits versus after-tax profits. This distinction is everything. As we established, the after-tax profit share the money companies actually get to keep and give to shareholders is currently sitting at the highest level in history. This is the fuel that is driving stock prices to the moon. But when we look at corporate profits before taxes, they are actually not at an all-time high. In fact, pre-tax profits relative to the economy are roughly at the same level they were at in the 1940s and 1950s. Think about what that means. Operationally, corporations are making just as much money relative to the economy as they did 70 years ago. They aren't necessarily better at business. The difference is that back in the 1950s, the government took a much larger slice of that profit. Back then, a higher corporate tax rate brought their share of the economy down substantially. The gap between what they earned and what they kept was huge. Today, that gap is historically small. We have a golden combination for Wall Street: high pre-tax profits and historically low taxes. We haven't seen a setup like this in roughly 100 years. Corporations are keeping almost everything they make, and instead of reinvesting that money into wages, which would increase personal income, they are funneling it back into the financial system via stock buybacks and dividends. That is why the stock market is disconnected from the reality of the average worker. The stock market is essentially reflecting this tax advantage. Now, this brings us to the scary part. The prediction. Theoretically, there is no reason why this divergence has to reverse immediately. It could keep going like this for years. The economy could keep growing while the consumer's slice gets smaller and smaller, until the middle class effectively vanishes. But history suggests that mean reversion is a powerful force. Eventually, things return to the average. What happens if this reverses? What happens if the political winds change, and the government decides it needs to close that gap between corporate wealth and personal struggle? If corporate tax rates were simply raised back to be roughly in line with where they were in the 1950s, the math gets ugly for the stock market. Such a move would bring after-tax corporate profits down to roughly 6 or 7% of GDP. In other words, it would shrink corporate profits by half, instantaneously. Now, I want you to imagine what happens to the S&P 500 if corporate profits are cut by 50% overnight. The U.S. stock market is highly tied to the growth of earnings. If earnings contract by 50%, it is highly likely that the stock market would contract by at least 50%. Probably more, because panic would set in. Financial assets would suddenly become much less interesting to hold. This would almost certainly cause significant short-term economic pain. If corporations lose half their profits, they will fire people. Layoffs would skyrocket. The economic pie would shrink. However, in this scenario, asset prices, stocks, real estate, would take a much larger hit than wages. And mathematically, that would actually cause personal income share of GDP to rise. It would be a painful, chaotic reset. But it represents a potential transfer of wealth back from the few to the many. Now, we need to address the elephant in the room here: timing. As investors on the Invest with Alex channel, we deal in reality, not just theory. There is a huge difference between this scenario taking place in 2026 versus it taking place in 2030 or 2035. Because the truth is, in the here and now, we remain in one of the most profitable environments to be a holder of stocks in history. The system is rigged in favor of capital, not labor. And until the rules change, you want to be on the side of capital. Our conclusion is that the current administration and the likely landscape for the next few years remains tax-friendly for corporations. Neither party seems in a rush to crash the stock market by doubling corporate taxes overnight. We have very little clarity on what the 2028 elections will bring. So to us, it is highly unlikely that this great reversal takes place before the market has a clear vision of what to expect from the next administration. Another tax-friendly president would mean this environment continues. The gap widens. The stock market roars. The average person struggles, but a shift in sentiment, a populist movement demanding higher taxes on the rich, could bring about the scenario we discussed earlier. This video is absolutely not to be mistaken as a political opinion. I am not telling you who to vote for. I am acting as an analyst, giving you an overview of what I believe is the most important structural theme taking place in the U.S. economy today. The system has been flipped. The seeds for a major shift have been sown. So what should you do? You need to be aware. You cannot blindly trust that line goes up forever. You need to understand that your portfolio's growth is currently being subsidized by low taxes, not just economic brilliance. If you want a more granular look at our expectation for the market in the first quarter of 2026, and exactly how we are positioning ourselves to profit from this dysfunction while protecting ourselves from the risks, make sure to download our report in the description below. I'm Alex, and this has been Invests with Alex. Thank you for watching, and I'll see you in the next video.